Right now, over $1 trillion has been poured into artificial intelligence. Companies are spending more on AI than entire countries spend on their military budgets. And every single week, a new headline tells you this is the greatest investment opportunity of your lifetime. But here's what those headlines aren't telling you. The companies at the center of this AI revolution, the ones your 401k, your index funds, and your retirement savings are already heavily invested in, most of them are not making money from AI. Not yet, maybe not ever, at the pace things are going. And I'm not a Wall Street analyst. I'm not a hedge fund manager. I'm just someone who got obsessed with understanding where money actually goes. And I've been spending months staring at the numbers behind this AI boom. What I found genuinely scared me. So, in this video, I'm going to walk you through the 3 warning signs that tell me this bubble is closer to popping than most people think. And more importantly, exactly what you should do with your money before it does. Before we get into the warning signs, I need you to understand something that most finance content skips over completely. This isn't just a story about tech companies and billionaires. This is about your money right now. If you have a 401k, an IRA, or even a basic index fund, and over 60 million Americans do, then you are already one of the biggest investors in the AI boom, whether you chose to be or not. The S&P 500, which most index funds track, is now dominated by just 7 companies. They're called the Magnificent Seven: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla. And together, they make up nearly 34% of the entire index. Every single one of them is in a full-blown arms race to dominate artificial intelligence. So, when you put $200 a month into your index fund, which is a great habit, by the way, about $68 of it automatically goes into these 7 companies. That means the health of your retirement savings is now directly tied to how this AI bet plays out. And that's exactly why I think you need to understand what's actually happening under the surface. Warning sign number 1 is what I call the circular money problem. And once you see it, you can't unsee it. Here's how it works. Microsoft invested $58 billion into OpenAI. OpenAI then used much of that money to pay Microsoft for cloud computing services. Microsoft used those payments to buy Nvidia chips, and Nvidia turned around and reinvested back into the AI ecosystem. Let me put that in plain English. Imagine you and your neighbor agree to pay each other $1,000 to mow each other's lawns. You both now have $1,000 in revenue, technically, but no new value was created. The same dollar just changed hands. That's what's happening at the trillion-dollar level in AI right now. OpenAI, the company behind ChatGPT, the most famous AI product on Earth, is currently valued at $500 billion, but it generates only around $12 billion in actual revenue per year, and it's losing money every single month. To justify that $500 billion valuation, OpenAI would need to be as profitable as Apple, one of the most profitable companies in human history, within just a few years. Is that possible? Maybe. But is it the reason the stock is priced that way right now? Absolutely not. It's priced on hope, on belief, on the assumption that the future will be so big that today's losses don't matter. We've heard that story before, and the last time we believed it this hard, it ended very badly. Warning sign number 2 is the one that keeps me up at night, because it's not just a theory, it's history literally repeating itself. Let me take you back to 1999. The internet was real. It changed everything. Nobody debates that. But in 1999, investors got so excited about the internet that they started valuing companies based purely on the idea of the internet, not on whether the company could actually make money. Pets.com, Webvan, Boo.com. These companies had billion-dollar valuations and had never made a single dollar of profit. When the dot-com bubble burst in 2000, the Nasdaq dropped nearly 80%. It took 15 years to fully recover. If you were putting money into a basic index fund in 2000 and you panicked and sold, you locked in devastating losses. But if you kept investing through the crash, automatically, consistently, you eventually came out ahead. Now, here's the parallel that matters for today. The internet was real in 1999. AI is real in 2026. The technology isn't the problem. The valuations are. Nvidia's stock price is up over 800% since ChatGPT launched in late 2022. Not 80%, not 200%, 800%. And here's the question. Nobody on financial media is asking loudly enough. What happens to Nvidia's stock price if the AI companies buying their chips start running out of money to spend? Because right now, those AI companies are burning cash at a rate that makes the dot-com era look conservative. And that brings us to warning sign number 3. This is the one I think is most dangerous for everyday investors like us. Here's something that most AI coverage completely ignores, and I think it's the most important factor in deciding whether this bubble pops or keeps inflating. It's called the data wall. The way AI models like ChatGPT get smarter is by consuming data. Books, articles, research papers, websites, conversations. Every single piece of human knowledge ever written down. And here's the problem. We're running out of it. By 2026, AI systems are expected to have consumed nearly all publicly available human-generated content on the internet. Everything. Centuries of human writing, compressed and fed into these models. Think about what that means. The reason AI has improved so fast over the last 3 years is that we've been feeding it an almost unlimited buffet of data built up over centuries. But that buffet has a bottom, and we're getting close to it. When AI progress slows, and the evidence is already starting to show that it is, the companies that have been valued on the assumption of infinite improvement are going to have a problem. Because right now, the entire stock market's confidence in AI is built on one belief: that the technology will keep improving fast enough to eventually justify these insane valuations. If that progress stalls, the whole house of cards shakes. Now, and this is important, I'm not saying AI is going away. I'm not saying sell everything and hide your money under a mattress. What I am saying is that there's a very big difference between AI being a transformative technology and AI stocks being a good investment right now at these prices. Those are two completely separate questions. And confusing them is exactly how regular people lose money in bubbles. The us moment. Bring it back to the viewer's real life. So here's where I want to get real with you for a second. I've been studying this stuff obsessively for months. I'm not a financial advisor. I don't manage anyone's money. I'm just someone who genuinely can't stop reading about this stuff and feels like I have a responsibility to share what I find. And what I keep coming back to is this. The people who got hurt worst in the dot-com crash weren't reckless gamblers. They were ordinary people who just believed what they were told, that this time was different, that the rules of investing had changed, that missing out was the real risk. They weren't stupid. They were just uninformed. And right now, millions of Americans are being told the same thing about AI. So, let's talk about what you should actually do. Step 1. Don't panic and don't stop investing in index funds. I know that sounds contradictory after everything I just said, but here's the thing. Consistently investing in a broad, low-cost index fund like a total market fund or an S&P 500 fund is still one of the most powerful wealth-building tools available to regular people. The key is that you are investing in the whole market, not just AI. And even if the AI sector corrects hard, the broader market has recovered from every single crash in history. Every one. What destroys wealth isn't market crashes. It's panicking during crashes and selling at the bottom. Step 2. Check your concentration risk. If you have individual stocks in AI companies, or you've been buying Nvidia, Microsoft, or any of the Magnificent Seven directly, take a hard look at how much of your portfolio that represents. Financial advisors generally suggest no single stock should be more than 5% of your total portfolio. If you're way above that, it's worth rebalancing. Step 3. Build your financial shock absorber right now, not after the crash. This is the one most people skip. A 3 to 6 month emergency fund sitting in a high-yield savings account does 2 things. First, it protects you from having to sell investments at the worst possible time if you lose income. Second, it gives you the psychological freedom to hold your investments through a downturn without panicking. The people who come out of market crashes wealthier aren't the ones who predicted the crash. They're the ones who were financially stable enough to keep buying while everyone else was selling. Step 4. Diversify beyond just stocks. Bonds, real estate investment trusts, dividend-paying stocks, and even a small allocation to commodities like gold. These don't eliminate risk, but they smooth out the ride dramatically. When tech stocks crash, these assets often hold steady or even go up. You don't need to be a genius to protect your wealth through a bubble. You just need a simple, diversified plan and the discipline to stick with it when things get scary. Look, I'm not here to scare you away from investing. I'm here to make sure you're investing with your eyes open. The AI revolution is real. Some of these companies will change the world. But real technological change and inflated stock prices can both be true at the same time. The dot-com era gave us Amazon, Google, and the modern internet. It also wiped out trillions of dollars of wealth for people who bought at the peak. The difference between the people who got hurt and the people who came out ahead wasn't intelligence. It wasn't income. It was information and preparation. And now you have both. If this video helped you think about your money differently, subscribe, because this is exactly the kind of thing I dig into every week. I'll see you in the next one.